On today's hot sheet, we're talking about our weekly update on housing inventory, affordability, as well as an update on housing starts. Today is Wednesday, October 22nd. Actually, I don't think it's Wednesday yet. I think it's Tuesday, October 22nd. I've been in Vegas way too long. This is Byron Lazine, and the hot sheet starts now. Confirmed. It is Tuesday for anybody that was wondering. Been in Vegas since last Wednesday. Have a red eye tonight. We'll be landing in Georgia at realtor.com on what will be Wednesday morning. But I want to thank everybody before I lead in. First of all, obviously, let me know in the comments which market you are tuning in from. But I've been in this Las Vegas market for, again, the last 6 days. You can hear it, I'm sure. My nose can feel it. This dry heat is just absolutely killing me. But I want to thank everybody who made the trip out here for BAM Mania. Got to meet so many of you guys in person, and I'm just really grateful that in this market, with everything going on, 2 weeks away from an election, just weeks away from holidays, all of that, that you were able to make this trip. And so thank you guys so much. Incredible. Again, just really grateful we were able to spend that time. Yes, missed you yesterday, Jody. I was at Ari. I'm now over here at Virgin Hotel. Gonna do a talk for my buddy Sharon over at Rise real quick and then bounce out of here. But I was at Aria through the weekend, and yesterday's Wi-Fi was not going to happen. So hopefully the Wi-Fi here at the Virgin is going to allow us to get through. We've got a lot to get through, so let's get started. Let's get into housing inventory for the week. I've got Haley on the back end helping me out with all of the slides. Of course, you can get all the slides and the daily hot sheet show notes right into your BAMX platform. Let's go, Haley, if you can, to weekly inventory. Inventory for the last week has gone up. It's gone up slightly, gone up about 7,000 from 732,000 to 739,000. And if you're seeing this, listen, I know a lot of you guys listen to the replay. I talked to a bunch of people yesterday, like, I listen to the replay. That's awesome. Replay is available on Spotify and Apple, so great. No worries there. But those of you that are visual and can see this, this year, yeah, we're 33% more than 2024. But when you compare it to normal years on housing inventory, 2017, 18, 19, as an example, you see that in all three of those years, for weeks now, we've been on a slight decline in inventory as home sellers take their home off the market for what I just mentioned is coming ahead of us. The holidays, the winter, the end of the year. This year, we just also happen to have the election kind of mixed right in before the holiday season starts, which many would believe that would have reduced seller inventory, seller interest, sellers being on the market. Why don't I just take it off and see what happens? Whether they care who wins or not, it's just let me see the other side so we get closer to certainty. People want certainty. November 5th is going to bring certainty, whether you like the result or not. That makes markets feel better, makes consumers feel good. It allows homeowners to have more confidence in being on the market. Okay. So that's interesting. It's an interesting data point that we're still, if you look at the trend line, we're still trending up overall on inventory versus normal markets when you would trend down. If you ask people maybe 6 months ago, they'd say, oh, I think, there'll be what you see normally and maybe even an earlier, exit out of the market, but inventory keeps going up. There's a few factors that are involved in that. We're going to talk about affordability here and even the change in affordability that happened yesterday here in just a little bit. But one of those factors is that I see really good signs coming next year in terms of inventory. People are just done with being locked in. They're done with it. They have a move that they have to make. and they're going to go on the market. You also have some sellers who just um, have a life decision. You're not going to be at record low levels forever. And so now that we're starting to see those early signs that, hey, next year could be a really big year for inventory, right? So we are right now today at our inventory peak for the entire year. So that's very rare. Inventory peaks usually happen in August. So good signs for what's coming in inventory. If Haley, if you can pull new listings data, this is another thing we're watching right now. Where are new listings going? Are they going up, or is the inventory increase just being driven by sellers having a hard time selling their home? Well, at least listen, we're not at 80,000, right? And that's where we want to get to during peak months. And we didn't get there at any point this year. If you're seeing the chart in front of you, we never got there. But we are doing better than both years prior, 23 and 22, at this point. 23, 56,000 plus new listings for this week. 22, 57,000. We're up over 60,000. And yes, 23 was the lowest year ever recorded, but we are seeing a bounce from 2023. And again, that's a good sign, and coming at a time when you really see new listings start to plummet. Now, the plummet in 23 and 22 did really take place, in about a week, 2 weeks, which is matching right up with, obviously this year, November 5th. We'll see as we get into next week, like if that comes earlier, if we dip below, we would have to sit at 60,000 again next week as we look at this data to be in the same like 3 or 4,000 range above 22 and 23. So we'll have to continue to see what happens there on new listings. But the good news is we're another week of data and still seeing signs that 25 should have substantial, if it follows the trend of 24, should have substantially more inventory than what we're experiencing right now, just based on being at the highest point of the year, obviously as close as we are to November. We take a look at properties that experienced a price cut in the last week. Haley, we're still just below 40%. We're at 39 and a half. So we're not seeing, despite some of the struggles some markets are having right now with inventory, we're at 39.5% on price cuts. So we haven't seen a big increase on that. 38% during 2023, and 2022 is 43%. That's when the affordability shock with the prices really started to take off there. If we go to pending sales right now, we have 10.2 more percent on single family home pending sales, escrows, whatever you call them, in contract right now than at this point last year. So 10% more homes are under contract. All these signals are still stacking up to mean, hey, we're getting into a place where we can start getting out of this real estate recession and getting into a healthier market. If we're doing this now, late October, and some of these trends continue into November and December, 2025 spring could bring a real pop on the real estate market. It's important for buyers to know that, because while everybody else is competing in the spring and things are potentially popping, do you want to be competing then or finding the lull in the market, which could be right now? Could be just that one last little sleepy time here before we go on a run. Like, who's to say there couldn't be a run starting in spring of 2025 and going the next 2 or 3 years with all of the pent up demand that we've seen. Mortgage application has also increased the last 3 or 4 weeks. Okay, so we've got more mortgage purchase application than we've had the last 3 or 4 weeks. Purchase applications, while they were down last week, 7%, we talked about that last week. When I say they're up, their year over year growth. This is the first time in basically 3 years that we've seen year over year growth. When mortgage rates were running higher earlier in the year, 6.75 to 7.5. Basically, we're back up at that 6.8 number. We had 14 negative prints. So that those week to week prints, we had 2 flat prints and 2 positive prints. Now we did just see a negative print obviously this last week as rates pop. So when you get up to that 6.7 range on the 30-year fix, you expect to see week over week to the negative as we go back down to 6%, those positive prints. And when rates started falling in mid-June, we saw that 12 positive prints, 6 negative prints, 1 flat, 3 straight positive year-over-year price growth prints is what's happening right now. Okay. If we can go to the 10-year yield, Haley, yep, there it is. We're up at 4.1%. That's about where we're coming in today. And you can see how much momentum we've lost over just the last couple of months on that 10-year. We're not at, the highs of, April when we were up over 4.5. There's some fear in the market that this thing could, we saw 4.2 yesterday. So there's some fear in the market here that 10-year does move a little bit. And this is why that opportunity when we're at 6.11 recently on the 30-year fixed, when you saw that 10-year drop at the bottom level there on that chart, was a great opportunity for buyers. It was right before the Fed cut. Go to the spread between the 30-year and the 10-year if you can. Here we go. The spread is better than at any point. Imagine if we were in 2023 spreads right now at 6.8 on the 30-year fixed. That would look like 7.5 right now on the 30-year fixed. If this was 2023, if the relationship between the 30-year and the 10-year today was what it was last year, be at 7.5. And so while the rates have come back up to 6.8, and Haley, I don't know if you can pull up the rates here today. If you just go to Mortgage News Daily, Haley, if you already have that ready, that'd be great. For those that didn't pay attention yesterday, 6.82 was the final reading yesterday versus 6.68. There it is. If you go up to the chart right above that, zoom out. There you go. Look at this rapid increase that we've seen here recently. What are the reasons for that? Remember the 253,000 jobs that we saw just a few weeks ago being added into the economy. The market's going to react to that. Whether we think there's going to be a revision move forward when we look back in 6 months, oh, they revised that number down. Well, the market will react then. But that's not the case today. They're reacting to the 253,000 jobs. They're reacting to positive inflation reads. And the market is also reacting to what the Fed said this week, right? For those that already saw it, the Fed is saying, we don't know. And Haley, if you can pull up CME Group here in a second, we don't know what's happening in terms of how many rate cuts we're going to happen over the next 2 meetings. We know the next meeting in November, what CME Group says, but the Fed is being very cautious about 2 rate cuts. Remember, the markets kind of had priced in 2 more cuts, whether it be 2 cuts at a quarter point or 1 cut at a half a point. CME Group's leaning towards a quarter point cut in November. Here it is, 89% chance that there's going to be a quarter point cut come the November meeting, and only a 10% chance that they don't do a cut. But right now, the messaging from the Fed yesterday is that, well, I don't know, we may just do 1 cut and see where it goes. Okay. If that happens, or really what the market is hedging for is if that happens, this is why you're seeing the 10-year go up, obviously, and then that's impacting the 30-year. So they are hedging against the possibility of what the Fed is saying is a possibility that we might only see a quarter point before the end of the year instead of that additional half of a point. All right, moving on here now to affordability. Resi Club put out a piece, affordability strained housing market. And this is going to become more of a conversation. Every time we get back up to 7%, it will look like a less affordable market versus just, basically a month ago when we were at 6% on the 30-year fixed. But over the past few years, we've witnessed not only, an extremely hot market to a real estate recession, but a deterioration in housing affordability. U.S. median household income in January of 2020 was $65,000. The U.S. median household income now basically is $85,000. That's great, right? $20,000 more on median income. But the qualified income to afford a US home, median home, was 64,000 back in January of 2020. It's like 1,000, 1,500 less than what the US annual median income was. The qualified income today to afford a US home, median home, 119,000 versus the 85,000 median household income. This is home ownership has become, a further reach now for so many. Go to the chart here on this will show it in the line chart. And this is from the Atlanta Fed's qualified income metric, estimating the household income needed to afford median price US homes without spending more than 30% of annual income. Remember, affordability is not spending more than 30% of the annual income. Okay. So it represents the income level to afford a typical US home, now up at 120,000 when the US median household income is 85,000. So that's household income, right? The 85,000. So that's, you know, household, it can be two parties there, obviously. So a huge gap on who can obviously go out there and afford what's available on the market. And as you see more inventory, if rates stay here, you will start to see DOM go up, uh, months of inventory go up, all of that. The increase in the median household in percentage terms coming in at 29.3%. I think most would say, hey, I like a 29.3% increase in income, but the income needed to purchase in percentage terms is at 86.6%. Expect this number to only increase, obviously, as we see if these rates get up over 7%. I'm not predicting that they will, but if they do, that's something to look out for. All right. We also had a read on from U.S. Census read, Census Bureau and Department of Housing put out. And if you could put up the charts there, we had 1,428,000 building permits, 1.3 million housing starts. If you want to zoom into the chart on the right, Haley, that'd be great. We also had housing completions at 1.68 million. So housing completions, just go to the one on the right if you can. Line, there you go. Housing completions are coming in down. The completions in September, adjusted annual rate of 1.68 million, 5.7% below August level of 1.781 million. It is 14.6 above. That number is above September's 2023 rate of 1.466 million. If we look at housing starts now, September, the 1.35 million, and you say, just stay on that chart. It's 0.5% below the revised level of August estimate of 1.361 million on housing starts. It's 7.7% below the September 2023 rate. So housing starts month over month and now year over year, both trending lower. Builders are taking less risk in this market. Affordability being a factor. Also, the trends that we just talked about earlier, where housing, existing home inventory is trending up at a time when it typically trends down. That means good things for the existing home market going into 2025. Builders are going to pull off of the gas a little bit there, and you see that in housing starts. Building permits, that 1.428 million is 2.9% below August level, and it's 5.7% below year over year on 2023. So housing starts, permits, both trending down on a month over month basis as well as an annual basis as builders start to pull back a little bit. Housing completion, surprisingly, also down. I would have actually anticipated that number going up. But when you look at that green line, housing completions, it's like 1 month they're up, 1 month they're down. The overall trend is moving up as they try to work through the projects that they've started and get these completions done and onto the market. But as you push hard for 1 month, you see another month go down. And think about it. Well, actually, I guess that was for September. That was the last month of the quarter. So interesting that they had a down month in September being the end of the quarter. But all right, there you go. That's your monthly residential construction data. Again, 10-year coming in right now at 4.089, so almost 4.1 on the 10-year. 30-year saw a pop based off of those Fed comments yesterday at 6.82. There's your hot sheet here for today. So glad to be back with you guys. Really can't wait to get off of the road and get back in the studio. For BAMX members, if you didn't get a chance at BAM Mania to meet the folks over at Zoodealio, make sure you get connected at some point. We're going to obviously be doing some BAMX office hours with Zoodealio. You now have access to the Zoodealio platform. You can put your branding. By the way, BAMX is like the best deal going right now. Use Zoo to get into BAMX. If you don't have a BAMX membership, every BAMX member is getting Zoodealio as part of the BAMX experience. The Zoodealio platform, this is how passionate Zoodealio is about this community, BAM, and what we're doing at BAMX. The Zoodealio platform on a monthly basis costs more than all of BAMX. How do Zoodealio, they said this to me when we were in Vegas, hey, how do we get closer to the BAMX community? We want to be with agents of change. You give them a great deal, I said, because that's what we're building in BAMX with all of the courses every single month, the office hours, obviously the done for you content, BAMX in a box every single Friday. Now this great partnership with Zoodealio where you can bring 4 offers to your sellers instantly, along with all the other data packed into Zoodealio. BAMX members, make sure you take advantage. We already have double-digit deals going on from just BAMX members alone. Zoodealio's numbers are showing. So bringing more value to your sellers, as well as being able to just generate more listings, because you're not just coming in there and giving one option. Zoodealio partners with every single agent. So if they do decide to take that quote unquote iBuyer approach, you're going to be compensated as the agent. Zoodealio is not against the agent. They are for the agent, partnering with you and now partnering. And that's the reason why I've chose to obviously partner with them on this deal with BAMX. So get into BAMX, use code ZOO. Hope you guys have a great day. If you are still in Vegas at the Virgin, I will probably see you later on today. Until then, toodaloo.